Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, what will the markets focus on this week? Will it be the global economy, the U.S. economy, the Fed's meeting in Jackson Hole, Wyoming, or Friday's second revision to the second quarter GDP? All of that and more is what we're going to talk about with our panelists this week, who are Research Director Shiraz Mian, Tactical Trader and Senior Stock Strategist Kevin Cook, and that Market Technician Kevin Matris. All on this edition of the Roundtable. But there's a lot of stuff that's still impacting the markets and investors' decisions this week, not the least of which is Libya. Is Libya factored into the stock market, or is its only impact on the oil market?
I think the stock market and everybody else kind of got used to the stalemate that developed over the last few months, and the progress that the rebels made over the weekend and a day or two before that came as a positive surprise to everybody. So I think it was not factored into the market, and that's why you are seeing some positive momentum in the market today, and also some improvement in how Brent crude is coming down. So it is net a positive and a surprise positive for that, for the market, and particularly a positive jolt for Europe, who was the main consumer of the 1.5 to 2 million barrels of high quality crude that went off the market when the turmoil in Libya started.
So what is the Libyan situation's impact on oil?
The situation is that there was this huge spread that developed between the Brent crude and the WTI, the U.S. Benchmark crude, and the primary reason for that was that Libya, which was a major supplier to Italy, Spain, and the other European markets, that crude went off the market. Now, it was replaced by other crudes from Saudi Arabia and many other places, but the refineries are not exactly configured to process any grade of crude. And that was the reason why you were seeing this huge spike in Brent oil prices relative to the West Texas Intermediate in the U.S. As that comes down, it has ripple effect throughout the global oil complex, and that's the unwinding of that in anticipation that the rebels take over, exports resume, and normal oil industry operations in that country resume, and that's what we are seeing in the market right now.
So is oil going to tick up from here?
It should come down.
It should come down.
That's right.
Okay. All right. I saw it was up $1 this morning. That's why I asked.
That's WTI.
Oh, okay.
WTI has a different momentum of its own. Brent, which is moving and dancing to its own tune, has a different momentum. Brent is down. WTI is modestly up.
Okay.
Yeah.
Now that we got that cleared up,
Yeah.
Kevin Cook, talk to me about recession here as far as the global economy and the U.S. economy is concerned. Is the economy in as dire a shape as the stock market suggests?
Well, that's the big question. You know, it's all about your growth estimate here, right? Ever since we got those GDP numbers on July 29th, the institutional investors have been pricing in a recession.
Yeah.
You know, if they were at, hey, there's only a 5% probability of a recession in July, they went immediately to a 40% chance, or in some cases higher. So we don't know yet, right? We're waiting for more data, and we got dismal data last Thursday with the Philly Fed. That thing plummeted into recession territory. So everybody's forecast now is, hey, there's a really good chance we could slip into recession here. We just need more data.
Yeah,
one of the tipping points could be Europe.
Okay.
You know,
given that Germany's economy is contracting?
And that that stalemate over there about how to help out Club Med, you know, could be reaching an end game soon, right?
Yeah.
A lot of tough talk from Merkel and Sarkozy last week. You know, we're not going to increase the bailout fund.
Right.
We're not going to issue Euro bonds. And then over the weekend, you know, Merkel really standing tough and not saying, hey, we're going to start kicking countries out, but just trying to hold their ground that, hey, we don't want to go to a debt union. You know, this is supposed to be a monetary union, not a debt union. So you've got observers like Mohammed El-Arian of PIMCO saying maybe the best thing here is a smaller euro. Now that still may be 2 years away. But something, you never know. Something, we could have a black swan here, and the fact that they're slipping into recession, you got Morgan Stanley lowering growth estimates for 2012 for Europe down to 0.5%. That could be a tipping point for a more severe U.S. recession here.
Kevin Matras, is the selling overdone?
Well, I kind of think the selling right now could be overdone. To talk about what Kevin was saying, Germany is going to really be in the spotlight. Everybody is worried that a slowing European economy is really going to have an impact on Germany. Germany's economy is still expected to grow at 3%, but if they start ratcheting down, I mean, they are so export-driven. As the rest of the world starts to contract, it's probably going to have an impact on them. But right now, Germany is okay, and the world really needs Germany right now. But in regard to the market, I kind of think the market is overdone right now, only because the brightest minds right now are putting the odds of a recession at about 30 to 40%, but the market seems to be factoring in 100% a full-fledged recession. So the difference right now, in my opinion, is while it is true the economic outlook looks terrible, the fact of the matter is businesses are in the best position now than they ever have been. So I think you're going to need to see a lot of additional economic data in the coming weeks and in the coming months in order to finally determine if the market breaks down lower or we're able to retrace back up into the 1250 area for the S&P.
You're going to be focused on Friday's GDP numbers?
Yeah, I mean, how can you not? The GDP a couple weeks ago, that was a game changer in my opinion. That really reset everybody's expectations about where we were and where we're going. So it's going to be critical that we don't fall off a cliff in this second revision to Q2.
Anybody here expect anything major coming out of Jackson Hole this week?
Not much, but I would say that a lot of folks on the street are looking for a repeat performance from the Fed chief. Yeah. Recall that last year in the same conference he gave us the indication of the QE2. Right. I don't think QE3 is coming for a number of reasons. The most important being that we have a lot harder inflation readings than we had back then. And the Fed chief is managing a divided house. There are more disagreements within the FOMC to further quantitative easing than was the case last time around. He may discuss the range of options that are at their disposal, and that probably would be the saving grace for the market, but I'm not really looking forward to some clear indication that the Fed is on its way to start QE3 yet.
Well, in that case, give us your top stock pick.
Enterprise Products. It's a pipeline and energy infrastructure play. They have oil, natural gas liquids, pipeline, storage, fractionation assets, solid balance sheet, very good cash flows, stable dividends that doesn't really fluctuate to the same extent as the fluctuations in the broader economy. Pay a very good dividend, what they call as distributions. It currently yields in excess of 6%. Okay. A very good pick for these turbulent times.
Kevin C.
Southern Copper. If you believe we're not headed into recession, okay? Southern Copper, good amount of reserves, hedged above $4. Copper is trying to hold on to $4 here. If it slips below $3.50, that's probably an indication we're going into recession. As they call copper the metal with a PhD in economics, it's indicative of industrial demand and what's going on. Current dividend yield is 8%. That's why I like Southern. Kevin mentioned a cliff. I see 1100 as a cliff on the S&P. The market could pivot either way from there if you see recession coming.
All right, Kevin M.
Mine is Elizabeth Arden, ticker RDEN. They're in the retail industry, and they do cosmetics, fragrances, beauty products, this kind of thing. If you look at the fundamentals, there's a lot to like. They have double-digit growth rates. They have upward earnings estimate revisions across the board. They've got a price-to-sales ratio that is well below the industry median. And they also have a Zacks rank 2, which is a buy. If you were to look at it chart-wise, I like the way the chart looks because there is an unmistakable consolidation pattern, and it looks as if they're getting ready to break out. My price target is $36.50. and that is a 17.5% increase from where we are today. I think that's a great industry to be in, and it's not really focused so much on the the industrials and all of that stuff.
All right. That's the latest thinking from these gentlemen, and with everyone here, I'm Terry Ruffalo.